All right, can't wait any further. So, hello everybody. My name is Terry Bryan and I'm a Member Services Consultant with Tasplan. With me today, as usual, is another of our Member Services Consultants, Danielle Bartlett, as well as our very special guest for today, David Stuart. But I'll get to David in a moment. Danielle will be in the background monitoring all of your questions. Danielle, can you please say hello?
Hello everyone, and thank you for joining us for tonight's investment information session.
Thanks, Danielle. And speaking of questions, if you do have any questions during the presentation, please feel free to type them into the Q&A box that you will see on the bottom of your screen. Now, we've made time at the end of the presentation specifically for questions to David. However, please remember that we have limited time today, so we may not get to everyone's questions in our allotted time. For those who are wondering, the presentation should take roughly between 35 and 40 minutes. But before we start, I'd just like to remind you all that this presentation is of a general nature only and does not take into account your own personal situation. Should you ever require personal advice, we always recommend that you speak with a financial planner. So with me today, locked up in Melbourne for his COVID, is our Acting Chief Investment Officer, David Stuart. David, thank you for joining us today.
Thank you. Thanks for having me.
Now, David is responsible for managing the strategic direction of Tasplan's investment portfolio. With nearly 40 years experience in the investment industry, David came to Tasplan in July 2019 with a wealth of knowledge about the fund. David was previously lead consultant with our asset consultant Mercer, advising Tasplan for over a decade. A former partner of Mercer's wealth business, David also served as the chair of Mercer Australia's Dynamic Asset Allocation Committee, as well as chairing the Global Dynamic Asset Allocation Committee. Prior to joining Mercer, David worked in a variety of roles in the industry, including the Regional Chief Investment Officer for HSBC Asset Management, where he was responsible for all investment teams across the Asia Pacific region. All right, so let's get into it. So David, let's address the one thing on everyone's mind to start with. What has been the impact of COVID-19 on Tasplan investments?
Okay, well, thanks for that, Terry. Thanks for the introduction and welcome to Tasplan members. It's a slightly unusual situation of addressing you from my family home. Look, it's been a busy year, I guess, would be the obvious response to that question. Clearly, the impact of COVID-19 on the economy and on financial markets has been very significant, and we've ended up with what I'd describe as something of a roller coaster in markets. When the outbreak really started to pick up strongly, late February and through March, financial markets reacted equally strongly. We saw a very dramatic fall in equity markets through March. And then they bottomed out towards the end of March and started to recover. And in fact, they recovered fairly quickly as well. So a very sharp downturn and a very sharp recovery. And then since around June, July, they've probably leveled out a little more, maybe grinding higher in general. But as people will be aware, over the last month or so, we've seen markets retracing a little bit. So it's been an up and down year for markets, and most of the other markets also had patterns strongly linked to the outbreak of the virus. And clearly what the markets are most concerned about is the impact on the global economy of the measures undertaken by governments to control the spread of the virus. As some people say, it's probably the first recession. Normally you would say that governments don't expect recessions and then they react to it. In one sense, the government's actually created these recessions by deliberately hibernating the economies in order to try and dampen down the spread of the virus. So this time around, the governments have, in one sense, had the levers of control, but obviously they can't control an economy that accurately. From our perspective, the Tasplan funds are generally very well diversified, and that's probably the most important factor when you enter into sort of high risk events and events with high levels of uncertainty. So we didn't encounter any significant issues with liquidity or with our asset class positioning as we went through this strange roller coaster of activity. Clearly, because markets fall, we did see quite a few members switching into cash, and then we had the government allowing members who were in financial difficulty to have withdrawals from their super of up to $20,000 in total. And Tasplan has had to deal with providing liquidity into those situations. I'd say a couple of things. Firstly, Tasplan probably wasn't as badly affected as some of the other industry funds, which maybe had a lot of young people with small balances, and they tend to have lost a higher proportion of their assets as a result of that. But also, we do have quite liquid portfolios, so we really didn't encounter any significant liquidity issues, although clearly there was a lot of forward planning undertaken, particularly around the early withdrawals. I'm pleased to say that we did manage to finish the financial year with positive returns across all of our major multi-choice options, running from the conservative option up to the growth option, albeit very low returns, obviously, by historical standards and also by our long-term expectations for those. But that will happen in markets when you have, difficult situation and a bad year. And I'm pleased to say that the diversification really meant that we still managed to deliver modest positive returns rather than falls in value. And I hope that, that would have been good for the members in Tasplan options. So it's been a tricky year, but by no means a disastrous one.
What do you see as the outlook for Tasplan for the rest of the 2020-21 financial year then?
Yeah, looking forward's always a little harder than looking back. And so the first thing I'll probably say is, there is still a very, very high level of uncertainty. And from an investment perspective, looking to the end of this financial year, that's a 9-month period, we would call that a short to medium term horizon, not a long term horizon. So there's a degree of uncertainty as to exactly what will happen this year. In terms of the economic and health outlook, I think there is still, enormous uncertainty as to the progress of the disease. We're clearly seeing upsurges in Europe at the moment. The United States has been through a period where the virus has been controlled in some states and areas, but then re-emerged in other ones. And so we've had this kind of rolling catalogue of virus outbreaks across the United States. And clearly we're also still seeing quite strong growth in some of the developing economies. India in particular is being hit quite hard. Here in Australia, we have, done extremely well, even in Victoria, which I'm sitting in. We have done extremely well by global comparisons, and clearly even in Victoria, the virus is now subsiding, even if the lockdown measures don't seem to be at the moment. Now, Australia, I think we do have to recognise there is a chance that there'll be an uptick in cases at some point in Australia as well. And of course, every time this happens, potentially there are economic impacts from the measures which governments will put in order to try and control the virus. And we can see that at the moment in, the relatively low growth that Victoria is seeing relative to the other states, which are sort of more in a sort of recovery mode. So the economy uncertain, the best guess is that things will be, they have bottomed and things will pick up. I think that even with second surges, the measures being implemented don't tend to be as severe as the initial measures. So I think we will see a grinding recovery in economies, but it will be some time before we get back to the levels of economic activity which existed prior to the virus. So before we get back to 2019 levels of economic output, it could well be the end of next year before we get there. So I think it is still going to be quite a long period. As far as markets are concerned, it would be fair to say that equities are reflecting, they have recovered because they think we're past the worst, and they will be susceptible to a strong upsurge in viruses, particularly in one of the major economies like the US or Europe. But generally, markets are now reasonably fully valued, and therefore there isn't the same recovery potential in markets. So fairly modest returns, I think, and a relatively, as I say, a relatively high volatility going forward. And when we look at more safer assets, such as government bonds and cash, although they're safe, we know that from the current interest rates that you're going to get very, very low returns, between 0 and 1% sort of returns out of cash and fixed and, what I might call genuinely safe fixed income investments. And so I think modest returns is probably the message, but hopefully they will be positive and probably, hopefully around the 5% level rather than the 0 to 2% level we've seen over the last 12 months.
Excellent. Expanding on that a little then, what do you think the economy will be for the outlook will be for the Australian economy, given that we're now officially in recession for the first time in nearly 30 years? Of course, included in that would be the outside influence of recent difficulty Australia is having with China, for example.
Yeah, so look, Australia is bouncing back at the moment, and I think that we will move back to positive growth as we move through the next few quarters, subject to the rest of Australia not catching the kind of colds that Victoria currently has. But some things are likely to take a long time to recover, and clearly travel restrictions are still in place across Australia and also between Australia and the rest of the world. And those are likely to come down only very, very slowly. And the problem for Australia is that, in fact, some of that affects some important sectors of the Australian economy. The two obvious ones are tourism and education. Tourism, clearly, if we don't have foreign visitors, then the tourist industry is going to continue at a very sluggish sort of pace, even with domestic tourism coming back. But international tourism was a big export earner, in fact, for the Australian economy. And also education, where people will be aware our universities have increasingly had a high proportion of foreign students who pay significant fees. And also we've had a lot of English language students coming to Australia. And again, they're likely to come back very, very slowly. We saw this before when there's been a disease outbreak, that foreign tourists tend to be much more reluctant to go to an overseas country for a prolonged period of time. So I think that those two areas are going to remain sluggish, and that will have an impact on our economy. Now, on the other side, we have had very strong government spending, or what we will call fiscal stimulus, over the last 6 months to offset the impacts of the economic hibernation. And that has helped to keep the economy, in reasonable shape. We know that that is going to be tapered, but Josh Frydenberg has made it clear that he recognises that any attempt to get back to surplus is really years away at the moment. And I think that's good news. The government is going to have to continue to support the economy for quite some time as we gradually get back to normal. And that could be a timescale of 1, 2, or even 3 years before that occurs. In terms of China, China is by far our biggest export destination. Obviously, we sell an awful lot of iron ore and coal to China. It's also quite significant on the tourism education side as well. And certainly the political issues, currently flaring up between China and Australia, they're not great news for Australia. We've seen some impacts in the agricultural sector where the Chinese have put some tariffs on things like wine in order to, if you like, express their displeasure at some of the statements which have been coming out of Australia. But really the big one would be if they did something in the iron ore or the coal area. That seems less likely because it would seriously damage Chinese ability to, produce the steel, which is a very important industry for them. But certainly when you're sort of at a war of words with your largest trading partner, that's a slightly uncomfortable situation. And I think we need to accept that growth in Australia is going to remain fairly sluggish. Probably the one point I didn't mention, immigration has been a strong driver in Australia really for the last 10 to 20 years. Typically, immigration has added about 1% to our population and probably at least that amount to our GDP growth. And that's going to come down to very, very low levels. And so you immediately look at a growth number which is potentially 1% lower than we were used to over the last 10 years.
All right, let's expand that a little bit. Let's talk about the rest of the world. What about the US election? It's only 6 weeks away. How do you see this affecting the markets?
Yeah, predicting the US election is probably even harder than predicting stock markets. I mean, I guess clearly Biden is in the lead, but I think by no means is it a certainty that Biden will be elected. There's a variety of points. I mean, number one, that there's a very active campaign, and we've got presidential debates coming up, and it's not clear how well Biden will fare through those. You've also got problems with the election itself, with postal ballots potentially delaying the outcome of the election and maybe affecting the number of people who actually can vote. So I would say that although we would expect Biden to get in, but by no means a certainty, a significant possibility that Trump could still remain in power. In terms of the market implications, to be honest, in the US, there hasn't been that big a difference between presidents of either the Democrats or the Republicans in terms of the performance of markets, and that might surprise people. But I was looking at some research the other day which showed that, in fact, the growth in the equity market under the 8 years of Obama was very, very similar on a per annum basis, very similar to the returns that have been earned under the last 4 years of Donald Trump. So, in fact, Obama was also very strong for the equity markets, and therefore it's not clear that suddenly Democrats will be a big negative. But I think it is fair to say Trump has been very pro-business. He's obviously had tax cuts for both businesses and the wealthy, and that tends to obviously fuel the stock market, and we're not going to see much more of that if Biden gets in. And there may be some retracement in some of those taxes in order to fund welfare spending. But the other side of the coin is that Biden is quite likely to have quite strong stimulus in areas like infrastructure, which will support the economy. So I don't think it's that the market will fall 10 to 20% if Biden gets in, but I think at the margin you would say that the markets will be slightly happier with Trump than Biden. So that's something we just need to try and factor in. The other factor I should maybe mention is probably more important to the markets would be if the Senate went Democrat as well. So if you had the Democrats holding both, all three arms of government, the House, the Senate, and the presidency, then I think there might be slightly more market dissatisfaction with that, with the concern that basically the Democrats could do whatever they want once they've got control of all three areas. So that's maybe an outlier, although the Senate's looking increasingly a toss of a coin, to be honest, between the two parties.
Are there other similar issues that affect the global markets, like a no-deal Brexit still on the cards? Hong Kong is still in a bit of turmoil. Can you see that affecting markets as well?
Yeah, look, there's always big issues bubbling under, as it were. Brexit's clearly a very important one, and again, no one's quite sure what's going to happen with Brexit. What the markets won't like is a no-deal Brexit, and basically markets like trade. Trade generally is very good for the corporate sector of any country, and if Britain falls out of the EU without a trade deal, then that's going to be bad news for the UK economy. It's fair to say the UK economy is already struggling quite a bit, and we've seen weakness in both the stock market and also in the pound, really reflecting the fact that the UK has had a bad virus outcome, and it's having to face the problems of Brexit. Hong Kong's a little different because it is really, a part of China, a segregated area. And typically the markets have looked through the political issues with Hong Kong, believing that the Chinese government still is obviously very keen to maintain Hong Kong as a financial centre. So I think something really bad would have to go wrong with Hong Kong for that to have a major impact on markets, although clearly the Hong Kong and Chinese markets would be impacted if the disputes just continue to run on and continue to escalate. But I'd also say, there will be other issues. I mean, there's always issues. I always feel that the issue which tends to bring markets down is the one you didn't actually have in your scenario analysis. And I'd have to confess that that was true of COVID. We didn't have a pandemic as one of our risk factors, and something else could easily crop up around the world which could dislocate markets. But that's just the nature of the environment at the moment.
What do you think about the recent push for responsible investing, and what's Tasplan doing in this regard?
No, well, that's an interesting question. I mean, Tasplan, does consider responsible investment as a very important area, and we feel, we are committed to being responsible investors within the Australian superannuation landscape. We've adopted an ESG framework. In fact, we for over a year now, we've had an ESG specialist in the Tasplan investment team. And we're working through our policies and guidelines to make sure that we can exercise, the right communications to the companies in which we're invested in, and also make sure that we don't invest in companies which are involved in activities we really don't agree with. Modern slavery would be probably one of the serious issues there, which we try and ensure that our fund managers have procedures to identify any issues of modern slavery being used in corporate supply chains. Obviously, the big issue tends to be climate change at the moment, and that's a medium to long-term issue, but a very important issue. And we make sure that our fund managers are incorporating climate change risk into their portfolios, so that when they're assessing, which stocks they want to invest in, that they bear in mind the risks that climate change could force quicker and more substantial changes, particularly in energy areas than maybe we might currently expect. So that's something that we focus quite strongly on our fund managers' capabilities in that area. We are a signatory to the UN PRI, the Principles for Responsible Investment, and we're also a member of ACSI, which is the Australian Council of Superannuation Investors, again, who tend to have an approach to corporate governance, which they try and corral, if you like, the super funds into acting together. And on that area, I mean, people may have read in recent weeks that there have clearly been issues with Rio, with destroying some very old, 46,000-year-old Aboriginal cultural relics in Western Australia. And we were co-signatory to a letter that was sent to Rio's board, where we expressed our dissatisfaction on what were considered rather lenient penalties applied to a handful of their senior staff. Now, shortly afterwards, Rio actually announced far more severe action, and actually some of the staff were forced to leave. And I think, we will have been part of the industry response, which told Rio these actions are completely unacceptable, and you need to demonstrate that you recognise that in your forward action. So I think that was quite an important facet for Tasplan to become involved in.
Excellent. So that's all the questions I've got at the moment. So thanks very much for that. What we'll do now is we'll get to the questions that you want to ask. Remember, if you want to ask a question, please, the only way to ask a question is to type it into the Q&A box at the bottom of your screen. Danielle, do we have any questions?
Yes, we do, Terry. There's a couple of questions that are posed up on the board at the moment.
All right, let me have a look at those. So, all right, so the first question we have is from Ray. Ray asks, with all this money printing, making it out of thin air with no asset base, how do you see inflation in 3 to 5 years?
Yeah, that's a good question. Look, money printing is, it tends to be a slightly, it's a phrase which is used, but its definition isn't terribly precise. So it's fair to say that the various money supply measures have risen quite significantly because of the quantitative easing that central banks around the world have been undertaking over, actually, in many countries this goes back almost to the GFC. So quantitative easing really started shortly after the GFC in the US and then Europe and then Japan. Australia is a latecomer to this area. Obviously, we didn't have the same economic problems following the GFC as we've had with the virus. And there were many people who were concerned that action, that quantitative easing, would boost the money supply and cause rampant inflation. Now, those fears were first expressed in 2010. So people who thought that would cause inflation were at least very, very early in their warning, and probably wrong, to be perfectly frank. Now, the current stimulus measures being put in place, in theory, are doing similar things. They are deliberately trying to push money into the economy to keep it going. But the reason they're doing that is that there is a lack of demand in the economy. And therefore, while there's more potential supply than there is demand, you are very unlikely to get inflation. So the inflation issue will crop up if this continues once economies are actually operating closer to full capacity. And then potentially, if this particular method of stimulating the economy were to continue, you could get some inflation spikes coming through as an outcome of that. Now, I personally think that that's at least 2 to 3 years away, and therefore it's not something we need to worry too much about in the short term. In fact, in the short term, I'm more worried about very low inflation or even economies dipping into deflation, given, again, the problems that we've got in terms of getting the economies back to work. So I don't think inflation is a strong short-term worry. I think will come back as a more medium-term worry, because I think we are going to have a situation where governments continue to try and spend, and that interest rates will be held very low by central banks to support the economy. So I think that some inflation risks may appear in 2 or 3 years' time, and then it will be a question of, how do governments and central banks react to that. I don't think there is any intention to let inflation out of the bottle. I think central banks will tolerate inflation at 3 or 4%. I don't think they would tolerate it above 5%. But of course, I myself I am quite old. I lived through the 70s, and no one intended to have inflation of 15% back then. So it can happen, but I think it's quite a long way away, that kind of threat.
Thanks for that. Next question is from David. My question is, wages growth has been flat for some time. Can you see this changing in the next 2 to 3 years? And can you comment on this, please?
I'm afraid the slightly depressing response is I don't see it changing in the next few years. I think, as I say, the economy is going to be operating below capacity, and it will be very hard for workers to get wage increases significantly above what is a very, very low level of inflation. There'll be relatively high unemployment, and also what economists call underemployment. So this is people who are maybe only working part-time and they'd rather have a full-time job. And while you've got that pool of excess labor, typically you don't see strong wage rises. So I'm afraid I think that's likely to continue for a while. Australia is not alone. We've seen this across the world. The US has really had virtually zero wage growth for 20 or 30 years now. And I think there is some political will building to maybe do something to try and change that. Clearly, there's some structural things which have caused that longer term very low wage growth. And globalization is one of them, but also, the increasing move to, ununionized sort of workplaces, and there's a variety of factors which have led to this low wage growth. And I think it will require political will to make a significant change to that in the medium term. In the short term, I think we're likely to see relatively modest wage growth in the Australian economy.
Thanks. The next question is from an anonymous person. It says, has Tasplan seen a trend of people moving between risk profiles or asset classes and which way has the swing been?
Yes, well, we have, and to be honest, it's exactly as we expect. So after the significant fall in markets in March, we did see a reasonable amount of money moving out of particularly our multi-choice options and moving into the cash option, which was people, I think, reflecting on, I can't afford to lose any more money, I'll need to go to something that's safer. Unfortunately, this always happens close to the bottom of markets, and we saw exactly the same thing around the GFC back in 2008. Since markets have started to recover, which is really April onwards, we've seen that that switch, stopped completely, and we've seen gradually people moving out of cash back into other options. So that's been the pattern we've seen. It does really reflect what market behaviour has been, and unfortunately, people tend to follow markets rather than move ahead of them. So people, there's a rule in investment. Don't invest money looking in the rear view mirror. Don't try and drive looking in the rear view mirror. You've got to look at what's coming up next rather than what's already happened. And it's a difficult lesson, but I guess that's the lesson that people have learned. And that's why we do tend to suggest, that the safest thing is to have a long-term strategy that with a risk profile that suits you, and there's all kinds of factors which will affect that, but don't then allow events to cause you to think, I need to change my risk profile. Because if the risk profile has been thought about and discussed with the financial advisor, then it should be appropriate for you. And eventually markets do tend to recover, and really it's the long-term returns to things like shares and property which are most important, not the short-term noise that comes through.
Thanks for that. That's all the questions we've got. If anybody's got any questions, we've still got another 5 minutes or so that we've got of time for the presentation. I do want to just go back to our session on Tuesday, where one of the members asked about tech stocks. And I think the question was relating to, are they overvalued at the moment?
That was a very topical question. In the short term, the answer should have been yes, they are, because I think they've all come off. I think Tesla was off about 10% the next day. But in fact, I think the answer I gave was yes, they do look expensive. And I think that when we look around the world, I mean, clearly, most equity markets are down a bit. They're not nearly down as much as they were in March, but they're down maybe 10 to 15% sort of on a year-to-date sort of basis, reflecting the fact that the outlook is not nearly as good as we thought it was going to be. But the exception is the US, and the reason for the exception is the US tech stocks and stocks which are associated with technology. So it includes, your Facebooks and your Amazons and a lot of what are classified as consumer discretionary stocks, as well as pure IT stocks, your Netflix and your Googles and so forth. So those big stocks, and they are big, they're global companies in the US, they really went through the roof following the virus outbreak. They didn't fall much in the first place, and then during the recovery, they've moved to being, up about 50 or even more, even 100% from the levels they started the year at. And we'd have to say that we don't think that's justified. We do think that the virus has illustrated that these companies do have business models which is relatively resilient to the virus. Some of them actually did better because of the virus. We're all on Zoom today because of the virus. So Zoom has done very well out of the virus. There are some winners, if you like, even in a very bad situation. But the scale to which they have moved up really doesn't seem justified, even when you factor in the fact that interest rates have come down, and that will always support share valuations. So we think that there were the beginnings of a bubble forming in some of these tech names, that people were buying the story rather than doing any real analysis as to what should it be worth. The note of caution I gave was that bubbles can go on a long time and they can reach levels that you never expect. So we do still have some exposure to those stocks. In fact, we have one fund manager who invests deliberately in growth stocks, and they have performed incredibly well this year. They only form a portion of our global equity portfolio, so they're not dominating it, but certainly their performance has helped us to have quite a good performance in our overseas shares this year. We do think that at some point, the gloss will come off of those stocks and move to another sector. And that's why we do have other fund managers who specialize more in, stocks which offer good value, or stocks which are more defensive in their nature, or whatever. So we keep a diversified portfolio going because we think that this one sector probably has gone a little bit too far, at least in the short term. Although some individual names could still continue to deliver. But when it's such a large part of the US market, I think it's a slight wariness we have towards the US as a result of that.
Speaking of different industries, the next question again is from David, and he basically asks, agriculture appears to be a good growth industry for Australia. What sort of investment footprint does Tasplan have in this sector, if any?
Yeah, well, we have a very, very modest footprint in agriculture. We do have some investments in Tasmania, which are, close to the agricultural sector, but they are very, very modest relative to the total portfolio. Agriculture as a sector is an interesting one because it typically isn't a sector which is listed on the markets very much. So a lot of agriculture is done by private companies rather than listed vehicles. And a lot of it tends to be, by the standards of the economy, relatively small companies compared to the size of companies that we would typically invest in. The other issue with agriculture is that it's a very cyclical industry. So agriculture clearly gets affected by drought. It gets affected by weather generally. It gets affected by other regions' weather patterns, so that you'll see quite a high level of volatility in agricultural prices. They can easily double in a year and they can halve in a year. So it does tend to be quite a volatile sector to actually, invest in. And frequently we've found that the medium-term returns haven't been that great. I think that may reflect the fact that many people are in agriculture for lifestyle reasons, and therefore it's not necessarily an industry which might be called, being optimized for economic efficiency. So we have looked at a few agricultural proposals which have come through to us, but we haven't really made a major investment in that area. We feel that there's probably safer and higher return areas which can support the portfolio, but we'll continue to look at ideas as they come up.
Thanks for that. Now there is one other question here, but I don't know whether it's one we can actually answer. It does, I think, just go a little bit towards personal advice. So I'll just read it out, but I don't know whether we could answer this one. I'll just see how we go. I'm one of many that move my money out of the balanced portfolio and into cash. Would now be the time to reinvest into the balanced portfolio, or should I wait and see what happens until after the government removes JobKeeper and the insolvency trading protection rules?
Yeah, I mean, you're right in saying I can't give the advice to an individual. I don't know their situation, their circumstances. In terms of where is the question heading generally, I guess, what I'd say is that you have to accept that, the balance fund, and for that matter, all of our funds have recovered a lot since those lows, and therefore you need to try and put behind you whether or not the previous decision was right. It doesn't mean the previous decision was wrong. There was a lot of uncertainty at that stage, but the way things have turned out means that, it would have been maybe better to stay in it. In terms of what's the outlook from here, as I say, I think the outlook for the balance fund, and as I say, the outlook for the other multi-choice funds is a fairly modest return outlook, whereby, you're maybe not going to get the high single digit or even low double digit returns we've seen at times over the last 5 to 10 years. So as I say, we might be looking more in the around 5% type of returns. But on the other hand, we know that cash is going to give you a very, very low return. So it is a difficult balancing act, and it really depends on your own risk preferences and your liabilities, if you like, relative to your assets, as to how you should have your money invested. But we do accept that defensive assets, they will be safe. Cash and bonds will be relatively safe, but you're not going to get great returns, and you're not going to get returns probably above inflation in those areas. So depending on what your needs are and your requirements are, potentially if you want some modest real returns, you need to move up the risk curve a little bit from cash.
Excellent, thanks very much. That about wraps everything. I don't think we've got time for any other questions. I just want to say a very big thank you for giving us your time today. Just one final thing before everybody goes. You'll shortly be receiving a quick survey on your screens. Only takes 30 seconds to complete. It's just 5 very simple questions. I hope everyone enjoyed it tonight. I hope that you got some use to you. Keep an eye out on our website. We will be releasing some more of these webinars going forward. We will hopefully have a webinar with our responsible investment manager a little bit later in the month or towards the end of October. So just keep your eye out of that. And if anyone does want to talk to any of us, please call our contact centre on 1800 005 166. Dave, thank you very much once again for your time. Thanks for opening up your home basically to us since you're in lockdown. And I appreciate the fact that you've given us your time. Thank you very much. And hopefully we can do another one either early next year or somewhere next year. So thank you very much again.
Okay, thanks Terry, and thanks to all the members for tuning in. Thank you.
Thank you very much. All right, so we'll just leave the poll going up there for a little while longer, just to get it all finished off. Thank you for just taking your time, and thank you for joining us tonight. We hope that you have enjoyed the responses. So thank you, everyone. Okay, so that looks like everybody now who has wrapped up the polling. So we'll just end that polling now. Thank you very much. And that brings us to the end of the presentation. So thank you once again. Have a good evening, and hopefully we'll see you at a future presentation. Good night, everybody.
Good night.